The traditional moving average crossover trading has been around for decades and is surprisingly still a viable trading strategy that manages to catch some of the biggest trends in the stock markets. One of the most popular moving average crossover strategies is to trade two simple moving averages, one with a period of 50 days and the other one with a period of 200 days as shown on the chart. But how about the other periods? There must be other combinations of periods of moving averages that perform better than the traditional 50 and 200 days setting. In today's video, I'm going to run an optimization of a simple moving average crossover trading system by testing various moving average lengths to find out which ones performed the best. I'm going to do this on all S&P 500 stocks starting from 2003, and so the results will be based on a lot of data. Now, before I do that, if you're new to my channel, my name is David and I trade in a fully systematic way and publish videos where I quantify various trading systems or tools by backtesting them using a specialized software. If you're looking for inspiration to take away for your own trading system development, then definitely subscribe to my channel. Now, looking at this chart here, this strategy would buy when the turquoise line, which is the 50-day moving average, crossed above the orange line, which is the 200-day moving average. The position is held until the crossover takes place in the opposite direction, meaning that the strategy is a simple trend following strategy. Let's take the moving averages and test a number of various combinations. Let's test all possible combinations, starting from period of 50 days up to 250 days for both averages. What I want to do here is to find out which combination performed the best. I've started the optimization in a software of my choice called AmiBroker, where the optimization is run to start from 2003 and is being conducted on all S&P 500 stocks. Important thing to bear in mind is that all my tests, including this optimization here, take the historical index constituents into the account. Now, if you don't know what that is, I suggest that you do some research into this, as this is an extremely important concept to understand when backtesting trading systems in stocks. Now that I got the results of my simple moving average crossover optimization ready, let's find out which combination performed the best. The criteria to determine this that I will use is the ratio between the average annual return to the maximum drawdown, which is located in a column that I've just highlighted on the screen. The best combination is a simple moving average of 70 days combined with a simple moving average of 210 days, where the buy setup is generated when the 70-day moving average crosses above the 210-day moving average. As I said, all combinations are tested on all S&P 500 stocks, and all combinations include a couple of other rules which I will put in the description of the video for you. Let's have a look at an example trade. Two moving averages are plotted on a chart where the shorter 70-day moving average crossed above the longer one here, which would act as a signal to buy this particular stock. The stock would be held up until this point, where we can see that the 70-day moving average crossed below the 210-day moving average, which acts as a signal to sell the stock. Now, moving average crossovers have been publicly known for a long time, and I've always been quite skeptical about them. However, there definitely is some sort of a merit to them. The key is to experiment with them yourself and come up with your own version of moving average crossover system, rather than just blindly trading one without validating it first. Now, let's look at the equity curve of this particular moving average variant to see how it performs when compared to the traditional 50 and 200-day moving average crossover system. The 70 and 210-day moving average crossover variant is plotted in turquoise color, and we can observe that it's performing better than the benchmark, which is that traditional 50 and 200-day variant. However, by looking at the equity curve, this is still not something that I would personally be looking to trade, and so I definitely would be looking to fine-tune this system a little bit. However, do bear in mind that any changes you make and optimizations that you conduct need to be done on what's called an in-sample data, which is not what I'm doing in this particular video here, since I'm optimizing on an entire sample and that's not how I would normally do things. This video is not about how to optimize trading systems, but rather about giving you some inspiration as to where to start when looking for a simple moving average crossover system, or simply starter moving average periods that you can use as a foundation for your own system. But now I've used same moving average periods for both buy and sell signals, where this simple system buys when the 70-day moving average crosses above the 210-day moving average, and sells when the 70-day average crosses below the 210-day one. However, how about if we use a different set of averages for exit with a view to improve the performance further, meaning that we would use 70-day and 210-day moving average crossover to buy, but use a different one to sell. Let's have a look. I'm going to run another optimization, but this time it's testing the exit side only. The entry side is fixed to 70 and 210-day moving average crossover. All other settings are identical to the previous test I made, and I've put the specs in the video description. Again, the criteria I'm using is the ratio between the average annual return to the size of the maximum drawdown, where the higher the ratio, the better. The best performing moving average crossover variant for exit side of our simple moving average crossover system is 110-day and 230-day moving average. This means that when the 110-day moving average crosses below the 230-day moving average, sell signal is generated and the position is closed. Let's have a look at the final equity curves. The orange line is the equity curve of the traditional moving average crossover that's using the 50-day and 200-day moving averages. The turquoise line is the result of the first optimization I ran in this video, using the 70-day and 210-day simple moving averages, where the buy signal is generated when the shorter moving average crosses above the longer one, and the sell signal is generated when the shorter moving average crosses below the longer one. The green equity curve is the best performing candidate of the second optimization I ran, where the buy signal is the same as the previous one, so 70-day moving average crossing above the 210-day moving average. However, the sell signal is different. The exit side of the system uses a different set of moving averages, 110-day and 230-day moving average, where the sell signal is generated when the 110-day moving average crosses below the 230-day moving average. All other rules are identical, and I've put them in the description of this video. Again, the optimizations I made were made on the entire data sample, which is not how I would normally do this, as obviously by simply picking the best variants of a trading system on the entire data sample, we're running into a risk of curve fitting. That may result in the system being profitable in the backtest, but failing in the future when applied on unseen real-time data. I may do a video on how to optimize strategies sometime, but in this video I wanted to demonstrate that investigating different indicator look-back periods definitely pays off, and I also wanted to provide you with a moving average combination that would act as a foundation for your own system. The last thing is the comparison of the backtest report. The one on the left shows the final optimized variant of a simple moving average crossover compared to the traditional 50-day and 200-day moving average crossover on the right. We managed to double the average annual return and at the same time actually halve the maximum drawdown, which is quite impressive. That's it for today. Thanks for watching. David at Critical Trading, signing out.